In this video, we're going to talk about long-term versus short-term capital gains. What are they? What are the differences? What you should know about them? But most importantly, when it comes to long-term and short-term capital gains, what you should know before you sell. But before we get into this, if this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, Certified Financial Planner, helping you reach your financial goals. So long-term versus short-term capital gains. What's the difference? So long-term and short-term capital gains. With short-term capital gains, it's 365 days or less. With long-term, it's greater than 1 year. So that means it needs to be 366 days or longer before you sell in order to qualify for the long-term capital gains. Now, the long-term capital gains have a more favorable tax rate, either at 0, 15, or 20%, where the short-term capital gains are as ordinary income. So it depends on your tax situation to figure out what your short-term capital gains tax rate actually is. So let me go ahead and pull it up on the screen and take a look at the long-term capital gains rates, which also are affected by your filing status. So let's take a look. Now here is the 2020 capital gains rates for single filers. At the 0% for long-term capital gains rates, it's from $0 to $40,000. For 15%, it's up to $441,450. And for 20%, it's that $441,451 and above. Now for married filing jointly, the 0% doubles to $80,000 and the 15% goes from $80,001 up to $496,600. And at 20%, it's $496,601 or more. Now that's going to go up for 2021. And for 2021, the single filers goes up just a little bit to $40,400, where the married filing jointly goes up by $800 to $80,800 for the 0% tax bracket. Now, when it comes to your income, it's important to understand the differences. It is not your adjusted gross income. So for example, let's say that you're earning $100,000 and you have $10,000 in capital gains that are long-term capital gains. Your adjusted gross income would be $110,000. But when it comes to your capital gains tax rate, you have to subtract your standard deduction from your income and then look at your long-term capital gains. So again, for example, $100,000 in income. If you're married filing jointly, that standard deduction would be $24,800. That means we're going to take $100,000, subtract your standard deduction of $24,800. That would leave you with $75,200, which is below the 15% for married filing jointly. That means that $10,000 in the same example, $4,800 would count at the 0% tax rate. And then at $80,000 and above, that other $5,200 would be at the 15% tax bracket for long-term capital gains. So think of it like this. You have to calculate your federal income tax and then look at the long-term or the short-term capital gains. And from that point on is what your taxes will be when it comes to long-term or short-term capital gains. Now, the reason it's important to understand this difference is because with long-term capital gains, we just went through figuring out how to calculate it, but it still increases your adjusted gross income, and that could affect your credits or deductions. So for example, with the credits, you want to look at the saver's credit, the premium tax credit, or if you're a high income earner, the child tax credit. And when it comes to the deductions, that could affect whether or not you can contribute into a traditional IRA or even the Roth IRA. So that's why it's also important to understand that AGI will increase with your capital gains, but in order to qualify for those favorable tax rates, that you don't want to look at your AGI, but your taxable situation when it comes to those long-term or short-term capital gains. And then it comes to the decision that you need to understand when you're selling a position, whether it's long-term or short-term capital gains could change how it's taxed, but also you want to consider whether or not you're going to have credits or deductions that could be affected, and whether or not it's in this taxable year or the next taxable year. So the whole timing of when you're going to sell that position could be affected between long-term and short-term capital gains, but also whether or not it affects other things like the credits or the deductions, whether it's going to be added to this taxable year or the next taxable year. But you also want to be aware that now you're risking whether or not that individual position could go down by the time you're making that decision today if you postpone it. So there's a lot that goes into it, and there's no one right answer for every situation, but you want to take it all into account rather than just looking at long-term versus short-term capital gains, or whether it's taxed now versus later. You also have to look at the credits or the deductions, or if it's this taxable year or the next taxable year. And that is a brief overview of long-term versus short-term capital gains. If you have any questions when it comes to long-term or short-term capital gains, let me know in the comments down below so I can answer it on future videos. And if you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.